Hi, I'm Jessica Ng from Assurance Real Estate Acquisition Inc. And I have here Raeann Lefebvre, and she's our mortgage broker, and I have to say she's the best one. So I'll be asking her some questions today, hopefully to help you with any mortgage broker questions you might have. So for everyone to get to know who you are, Raeann, can you tell us a little bit about yourself and why you became a mortgage broker?
I have been a mortgage broker now for about 6 to 7 years.
Okay.
My first couple of years I was with the mortgage group and learning under a mentor, and then I went into my own brokerage about 2.5 years ago. I started my own company. So I have a lot of experience in mortgages now. I've done a little bit of commercial. I like residential more, and specializing mostly in real estate investors, self-employed people. So that's basically the areas that I'm most proficient at.
I can certainly attest to that. Raeann has helped us with a lot of deals, and it's the most creative I've ever seen. So Raeann, as a mortgage engineer with your company Keystone Mortgage, how did you decide to start your own company and become a mortgage broker in the first place?
With my experience as a first-time home buyer, never having that guidance, that education, that was my
The turning point for you?
the turning point. Yes, I wanted to make sure that I was educating people, that people didn't have that experience like I did.
The feeling of being lost, nobody helping you along, especially for a new experience, for a kid who's just got out of school, wanting to buy a new house, don't know where to go. Mom and dad can't really tell you because the world's so different now, right?
Yes.
Okay.
So I want to be able to educate clients and let them know what to expect in the different stages of the mortgage process and with buying a home. It is the biggest investment of your life, so it's nice to be educated on it. So I became a mortgage broker to help people do that, and I started my own brokerage, Keystone Mortgage, about 2.5 years ago, so that I could actually start training other mortgage brokers and bring on a team underneath me that I can teach the same values and morals and giving the clients the education that they deserve.
How did you learn all those little tricks?
Experience, talking to the lenders, knowing the lender guidelines is so imperative. Knowing the insurer guidelines as well. So when you know their guidelines, then you can basically create a deal and stick it in the box that the lender requires.
Okay.
So,
and each lender is very different, right? Because I've heard that rules change day by day, and sometimes even by the hour. So why is that?
The mortgage rule changes that have come into effect, we've had 4 changes in the last 3 years, which is very different. I mean, from the days when I first started, you could get 100% financing, cash back. Pretty much anybody could qualify for a mortgage. Then the subprime crash happened in the States, pulled back on a lot of our lenders, and that's when all the guidelines started to change. Canada didn't want that to happen, what happened in the States.
The housing bubble.
The housing bubble, and anybody could qualify. No, we want to make sure that only the people who have the required excellent credit, income verification, are able to purchase property and real estate now.
So it would go through you first before it goes to the lender, and you would make sure everybody could qualify and still take care of their own basic needs before you even allow them or suggest that they go look for a lender, right?
Absolutely. Absolutely.
What are some of the key things that you look for to help someone qualify?
The basic information, we have the 4 different parts of an application. You have the applicant, you have the property, you have the down payment, and the credit. So the applicant is their income, right? How strong is their income? How stable is their income? Are they on salary? Are they commission based? Are they self-employed?
Okay. And how does that make a difference?
Basically, it determines what you can use to qualify their income.
Okay.
So if somebody's on salary, it's very simple. You use their salary. They're guaranteed that income. If they're on probation, then you can't use that income because they can be fired.
Within the 3 months, right?
Exactly. Okay. After they're off probation, there has to be grounds in which to fire somebody. So we can guarantee that they're going to be getting that income.
So to show this, they would need to ask their employers for a letter, correct?
Yes, they would need a letter of employment and a current pay stub.
Just one pay stub or a few months?
Just one pay stub.
Just one pay stub. What about self-employed people?
Self-employed people, they have to have at least 2 full years of self-employment in order for us to use verifiable income on them. And I say verifiable because that's a very big part of it. There are other programs for self-employed people as well.
I see. Do they have to show some kind of proof of income?
Absolutely. With self-employed people, we like to see 2 years tax returns, the full T1 generals, 2 years notice of assessment, and if they are incorporated, ideally 2 years financial statements.
I see. Okay, and you mentioned commission people as well. How does that one work?
If they're on commission, we want to see 2 years of commission income because we can't assume that they're going to be making the same amount of commission every single year.
So within that 2 year, you're trying to look for consistency of the amount they're getting through commission.
Absolutely.
What if it's inconsistent? Like 1 year they're doing better, so let's say somebody started out, first year is maybe not so good, but as they learn all the tricks of the trade, they get better and better. Does that play a part?
Absolutely. We can use a 2 year average of their commission income.
Okay.
And if the current year is less, as you said, we're looking for consistency. So if the current year is actually less than the previous year, we can only use that income.
The lesser of.
The lesser of.
Yeah, and for those people who are self-employed, what if they can't, show proof of their income?
There are different programs that are available for self-employed people, and that's something that's not very well known out there. So generally speaking, you're looking for somebody who's self-employed, 2 full years of self-employment before you can verify their income. And that's the key, is verifying their income. You do need to have 2 years of tax returns where you review everything and determine what income you can use. So somebody who has been in the industry for the past 10 years and recently decides that they want to go self-employed, for example, tradespeople like to do that.
Yeah.
If they've previously been in the industry and they went self-employed, we can actually use a program called the CMHC Simplified program, which is a stated income program. So obviously we can't verify their income. They don't have the 2 years history in there. But if we can state their income at a reasonable level for their trade, then we can sometimes get it approved. And when I say sometimes, it's because it's a very, very detail-oriented product. So somebody who is looking at that product needs to have excellent credit. There can't be any blips on it in the past. They also need to have at least 5% from their own resources, meaning savings, investments. They can't use gifted funds in that situation, but they also need to have 10% down instead of 5. So the other 5 of that could come from gifted down payment, but they need to have full 10%, 5 from own resources, and the other 5 can be from other resources. So you have that requirement of 10% down, excellent credit, and you also want to see a decent net worth in that applicant. You want to see that it's a person who has just been setting money aside, doing really responsible things with their income, that we're not able to verify their income. And that's, again, one of the legs that I was talking about, where if the income is a little bit off, you want to see strengths in the other sides, in the other legs of it. If somebody has been self-employed for more than 2 years, but they choose not to pay themselves as much money, so they obviously don't want to incur the taxes on it, or there is a big cash component to their job. So again, tradespeople like to do cash jobs on the side. We can use the Genworth Alt-A program or the Canada Guarantee Low Doc program, where we basically, again, state their income. But we're going to want to see some more background proof of that. So we might want to see financial statements just to see how their company is doing, if it's healthy. But again, we don't have to use what their tax return says for their final line 150. We can use a stated approach to it. And again, excellent credit, down payment at least 10%. Okay.
What about those people who self-employed, went back to work as an employee for a period of time, and then became self-employed again? And it's shorter than that 2 year period when they became newly self-employed. Do they count that previous X amount of years they were self-employed?
If it was in the same industry, the same company, I would say we would probably be able to mitigate that using that time as well.
Okay. And you mentioned net worth a lot. What kind of factors play into net worth?
You're going to want somebody who has the net worth is established, especially in the stated income program, via equipment, tools. You expect to see that because you're spending a lot of money on that kind of stuff. Even vehicles are,
Okay, so
trailers.
jewelry, designer purses, things like that, that would all come toward a net worth?
Not necessarily.
Okay.
You're going to want those things that are for the business. And then, of course, the liquid assets, meaning the savings, the RSPs, the investments. Money that's left in your company is a big side of it. Because obviously you're choosing not to take the money out of your company to pay yourself personally.
Mm-hmm.
So you want to be able to show that I'm really just leaving the money in the company
Okay.
so that I don't have to pay the tax
Yeah.
on that.
Okay, so out of the company size, let's say it's an employee, does the jewelry and stuff now count as net worth?
Jewelry, yes, it does count towards net worth. It's just, we look at it as being part of your household goods, your
Okay.
personal effects,
Mm-hmm.
so it doesn't have as much weight as the liquid assets or the equipment.
Okay. So some other things that account for net worth would be any house you have, vehicles you have, minus the loan on it, and then things like maybe commodities, silver, gold, that type of stuff.
Yes.
Okay.
Property is a regular single-family dwelling in a major urban center. You are pretty much open to any lender that is out there. If you have properties that are acreage properties or even worse, farm properties, you have very few lenders that will actually look at those types of properties.
You said farmland is even worse. Why is that?
Because farmland, if somebody is a farmer and they're farming, they buy the property to be a farmer,
Okay.
you only have one or two different lenders that will actually look at financing somebody who is a farmer. And the
Okay.
reason being is because it's seen as more of a commercial side than a residential.
I see. Okay.
Somebody cannot be foreclosed on if you're taking away their livelihood and if you're taking away their land and their source of
Mhm.
income.
Okay.
It follows a different set of government guidelines.
Okay. So what are some ways that they can do, or what can they do to make it more attractive to a lender?
In regards to the property or the full
Yeah,
application?
to the property and the farmland.
You ideally want to be looking at in major urban centers. If you're
Okay.
looking at some acreage property,
Mhm.
then of course the rest of the income, the down payment, and the credit have to be impeccable because the property
Okay.
itself is not as secure. You have a smaller market of people who are going to be willing to purchase an acreage versus in the city.
Yeah, there's a lot of people who wants to live in the city versus an acreage.
Exactly.
Okay.
So that's where you have the four. I always like to say it's four legs of a chair. If one of them is weak, it can still stand up. But if two of them are weak, it'll fall down.
Yeah. Okay. So for the property, does it matter about the age, the condition it's in, and things like that?
Absolutely. If you're looking at a property that has foundation cracks or it's very old and dated,
Mhm.
the ampage of the electrical that's in the property as well, all those things will be a factor in regards to financing. So you want to, and another side of it is townhouses and apartment style condos. Those are also seen as a little bit more risky just because of the type of market that we have right now. They look at it as there's more flooding in the condo market than in the single family dwelling. And that's just right now. There was also a time a few years back where they felt the same way. I think it was just after 2007 where they threw a whole bunch of pre-built condos onto the market. So the market was flooded with condos.
Okay, there's just too many, it's too saturated right now to be
Exactly.
attracted to lenders. I see. So that could change at any time though, right? That's just the current market today. In the future, it could be that the single family house is the flooded.
Absolutely. And that's why you say that it changes day to day. Well, this is the
Mhm.
current situation that we have in Edmonton. So that's why they're looking at lower loan to values for condos and that kind of thing.
Okay. How does the lender assess the state of the property? I understand they do appraisals a lot. Is that how they determine what the house is worth and what condition they're willing to lend on?
Yes, but there's two different sides of that. When you're looking at mortgages, there's high ratio mortgages and there's conventional mortgages. High ratio is anything over 80% loan to value. It has to be CMHC or insured. So our insurers in Canada are Canada Guarantee, Genworth, and CMHC. We have 3. Anything over 80% loan to value has to be insured. If it's insured, the insurer, CMHC or Genworth, will actually do an appraisal on the property if they feel that there's any risk to it.
Okay.
So that's not a cost that's going to be incurred by the client themselves. On a conventional basis, anything less 80% or less, then the lender will require an appraisal, and with that appraisal, the client will be required to incur the fault.
For those people who doesn't understand what a loan to value is, can you please explain that?
Loan to value is the amount of the mortgage in comparison to the value of the property. So the purchase price or the current market value is what we base the number on, and then the amount of the loan that you request. So of course, subtracting the down payment.
The other thing you mentioned was credit, is that right?
Absolutely.
So can you tell me a little bit more about that? How does that affect how a lender would look at you?
Your credit needs to be, and this is a very basic guideline, your credit needs to be over 620. Now, credit scores with Equifax are on a range of 350 to 900. So anything over 600 is seen as good, anything over 680 is seen as excellent. So anything over 620, you are pretty much able to be
approved.
Pretty much able to be, I can't think of the word, insured. You're able to get financing through the A world.
Okay,
In the mortgage broker world, we have A lenders, B lenders, and C lenders. The A lenders are the major banks, mortgage corporations that offer the best rates and the best prepayment privileges. Then there's the B world, who are the alternative lenders. The alternative lenders look at people who have a little bit of weaker credit, perhaps they've recently gone self-employed, can't qualify on their income, softer income situations, and then the C world is the private lenders. So when we're looking at the spectrum of credit, anything over 620, you should be able to get financing in the A world. Anything less than 620, you might have to look at the alternative world. And usually only in extreme circumstances, meaning you're currently in bankruptcy or you've had foreclosures, major issues, you have to go to the C world, which is the private financing.
I see. So what can someone do to improve their credit?
The best thing to have, the ideal credit situation, is you have at least 3 credit lines, and in the bank world we call them trade lines. So you need to have at least 3 credit lines reporting on your credit bureau at all times.
So this includes your credit card, any loans you might have on vehicle as well, right?
Absolutely.
Are there any other ones?
Lines of credit through the bank,
Okay.
credit cards, vehicle loans, RSP loans, personal loans of any sort, yes. Anything that would be reporting on your credit bureau from the bank side. Mortgages do not report on the credit bureau. That is something they're trying to change, so that could change at any point. But at this point, they are not on the credit bureau.
Okay. For those people with weaker credit, would you suggest that they wait to find a house and repair their credit before they go find a property?
Absolutely.
So to do that, they can get a small loan, like a line of credit, a credit card, and start using that and paying it on time, paying it full, and that will help build their credit up, right?
Yes.
How long does it usually take for their credit to be increased?
It depends on how much negative credit. You know, there's the people that are just recently getting credit. You want them to go and get a credit card and have that reporting, even if it's a $500 limit. And then 3 months later, go and get a second credit card. As I was saying, the ideal is 3 trade lines. So even if they have 2 reporting at the same time, it'll increase their credit score, and their overall risk factor will be less quicker by having 2 trade lines. If they only have 1, it's going to increase very slowly. So you're looking at ideally a full year before you can qualify. Versus if they have 2 trade lines, you might be able to push it a little bit sooner, even 6 to 9 months. Being that they probably have been paying rent for the past year, ideally, so you can use alternative forms of credit to accentuate the credit, the Equifax report with lenders. If they've been paying rent, they have a cell phone bill, they have utility bills that they've been paying on time, you can use those alternative forms of credit to accentuate their credit bureau if there's nothing major no major derogs on their credit bureau.
I see. So even if it's something as simple as getting 2 credit cards, paying $10 on one, $10 on the other, instead of $20 on one, that would help them to decrease it from a year to about 6 to 9 months.
Mm-hmm.
Right?
Absolutely, and the important factor in that is actually using the credit card. It doesn't help to just have the credit card. If you're never using it, it doesn't actually report on your credit bureau.
For sure.
You have to at least, I say, put a tank of gas on your credit card every single month and then pay it off. If you're going to maintain a balance on your credit card, that's okay to do as well, as long as you're not exceeding 65% of the limit.
And to always pay in at least a minimum amount at the right time.
Absolutely.
Okay.
I always say it's better to pay twice a month than it is to just pay once a month, because then you're certain that you're covering your required minimum payment.
I see. You mentioned rent as a way of reporting your credit. How would somebody go about doing that? Because normally it could be through a personal homeowner and you're renting a basement. It's not necessarily through a property management company. How can we go about finding that information to provide to your lender?
Some lenders will allow us just to use a letter from the landlord saying that their payments have been made as an A1 status for the past 12 months. Some lenders
A1 being on time payment.
Absolutely.
Okay.
And some lenders will just want 12 months worth of bank statements to show that every single rent payment came out without an NSF.
And that would be the bank statement on the applicant side.
Absolutely.
I see. Okay, and the fourth thing you mentioned was down payment. How does that affect what the lenders see when you provide a certain amount of down payment?
The strength of the down payment is determined by its source. So somebody's savings account, obviously they've been very diligent putting the money aside to save for their down payment. The lender's going to ask for 3 months worth of bank statements to prove their down payment has been saved. They don't care what happened the prior 3 months before that, but 3 months is the key. You can use, for first-time home buyers, you can use your RSPs, you can also use your investments. Lenders will even accept, if you're not a first-time home buyer, to use your RSP, but of course there's the implication of the taxes on that that you would have to pay. But when you're looking at other sources, such as you can use gifted funds, gifted from an immediate family member, as another source.
Family.
Only immediate family.
And what's the definition of immediate family? Is that parents, siblings, grandkids?
You're looking at grandparents, parents, brothers, and sisters. You're not allowed to go to extended families such as uncles, cousins, second cousins.
Okay.
So gifted down payment is seen as your own resources as well, but it's obviously not as strong because you never put that money aside and were diligent with. But it is accepted. Sometimes it can be the weaker part of that leg if the rest of the application wasn't as strong. But if the rest of the application is strong and the source of down payment is gifted funds, that's completely fine. It's very common these days.
When you say weaker leg, how does that affect the lender in the whole picture?
That might be the situation where you're asking for an exception on the credit. Maybe their credit is not very strong, and then they have gifted down payment to boot. So it kind of gives you that overall things aren't as strong on that side. If the credit is just a little weak, has some small issues in the past, that might not affect the whole overall application as with having a gifted down payment. But if they've had previous bankruptcies or they've had major derogs in the past, that could be the thing that would cause the deal to be declined.
Okay, so that's the consequence. That's something the applicant might be declined if any of these legs aren't strong enough.
Exactly.
So will it ever affect the interest rate or the amount of time you can pay back, the amortization? Or is it just a decline or not decline?
If the situation that you can't get it approved in the A world, then it might be a situation where you have to take it to the B world because they don't have the strongest credit, because they may not have the best down payment. I might have to jump it to the alternative world, which then means, yes, you would be paying a higher interest rate. It's not a big difference. It's probably about a difference of 1 to 2% in interest rate, but it is a difference.
To a lender, what's the most ideal applicant?
The most ideal applicant to a lender is that professional who is salaried, makes
Okay.
it salaried income. They have the down payment from their own resources. They have
Like
excellent
savings?
credit. Yeah.
Excellent credit.
In that situation, if all of those sides of it are very strong, the applicant can buy an acreage without a problem, could buy a townhouse without a problem, because the property is not going to be that much of an issue.
Okay, just because the person has a record of being able to pay on time and have a very stable income.
Absolutely. Yeah. And then the other part of the down payment is using borrowed funds. So you can use borrowed funds for a down payment. That, of course, is only for people who are extremely strong with their credit and income, and there's no exceptions on those side of things.
So when you say borrow funds, is it like a line of credit?
Yes, you can use a line of credit, you can use a credit card, you can borrow it from a loan. That's another source of it.
I see.
Get a loan from a bank in order to have your down payment.
So in this case, there's a possibility that the property could be 100% financed.
Absolutely.
Okay. There are lenders out there who do that, then A lenders.
Yes.
So can you
Yes.
give us an example of something that you've done similar to 100% financing?
There was recently, I had a client go and get a personal loan from a bank.
Okay.
And as soon as I know the payments on that loan, we can use that. We just have to factor the payments into the debt service ratio as well.
Okay. Those people who doesn't know what a debt service ratio, can you explain that?
Debt service ratio is the ratio of the amount of debt to your income. So you would take the monthly payments on each of your required debts, meaning what is on your credit bureau, and you're not talking about any utility payments or cell phone payments or insurance payments.
So it's more like mortgage, if there is any, vehicle, credit card, line of credit.
Exactly.
Am I missing anything?
Nope, that covers
So
them.
those are your expenses, and then the income would just be the salary, if there is any, or commission, and then any rental, if there is any, right? Is there any other sources that I might be missing?
No, I believe you've covered it all.
Okay, so you take all that income and you compare it to all the expenses that the person had, and that's how you get your debt service ratio.
Yes.
So when you have a debt service ratio, what number is good?
You want to have 40% or less is ideal. You are allowed to go up to 42 and sometimes even 44, but you don't want to necessarily be pushing the guidelines there. With the GDS, the gross debt service, you're looking at the amount of income that is utilized in your annual income that goes towards your property. So what they take into account there is the mortgage payment on the property the taxes, and the heating cost on the house. So
The heating cost.
heating cost. And the lenders will generally use about, and this is an average, $100 a month for heating cost.
And heating is just the utilities then?
Yes.
Okay.
Heating of the house. That's
So
the
not
only
even
utility.
water or electricity, just heat.
Just heat.
Okay.
And so you would take those three, the monthly installments on the mortgage, the property tax, and then $100 for heat, and give that ratio with your income, and that needs to be at 32%. So there's two different ratios we look at in the mortgage broker world.
Do you look at a person's net worth at all?
Yes.
For what reason?
We look at it as strength of the application. So if somebody has a very strong net worth, it's obviously going to give us more strength in the overall application. It's not one of the legs that would cause the application to be declined, as I've been talking about. It's a situation where if they're teetering on the edge of being approved or declined, the net worth can just, they've
Give you that extra bump.
Exactly.
Okay.
And so if you have somebody who is in a negative net worth, and I've seen enough of those where somebody just got out of university, they have all the student loans, they haven't been able to accumulate much of a net worth yet,
Yeah.
that's not going to be a factor as much as somebody who didn't really go to school, spent a lot of money on toys, and not even necessarily anything that's going to give them that asset to offset the debt.
Okay.
Where they have a negative net worth just because they just haven't been as structured with their finances.
I see. Can you explain what a mortgage broker does?
A mortgage broker is basically the person that does the shopping for the client when it comes to looking for mortgages. So in the old days, I say the old days, but it is still kind of common. Somebody would, when they're ready to get a mortgage, they'll go from one bank to the next, looking for who's going to give them the best rate and the best situation for them. In each of these situations, the bank is going to pull their credit and they're going to do a full application in order to determine what the client can qualify for.
Right.
And the banks only advertise their posted rates. They rarely advertise a promotional rate.
So they don't necessarily give you the best rate when you go to them.
Exactly.
Okay.
So they're going to look at your application and look at your credit and say, well, Mr. Smith, you're such a good client. We're going to give you 3.29% right now. When really they can go all the way down to 2.99%. So you're thinking you're getting a great deal because you only know the posted rates that are out there. You don't know the fully discounted rates.
So a mortgage broker could help as far as getting you the discount rate.
Yes, we have access to 20 regular mainstream lenders that are giving us the best discounted rates at all times. There's no bartering with them. They give us the rate. As long as the client qualifies, that's the rate that they get. And when I mean they qualify, it's talking about those four legs again. If you're strong enough to get approved, you're approved for the best rates that are out there. So we have all these different lenders that are available to us, and a lot of them are not the banks. We have access to most of the banks other than Bank of Montreal and Royal Bank. But we also have access to major mortgage corporations, trust companies that do mortgages as well. And they have to give the best rates because of the fact that they are not on every corner like the banks are. They have to be competitive.
Okay.
But they also have to offer good customer service and good prepayment privileges because that's important to the clients as well. You want to find out about your mortgage. Well, that's the reason you go to the bank is because they're on every corner. You can walk into a branch and have that person. So they have to have that ability to either phone them or look up their information online so that they can look up the details of their mortgage, make changes to the mortgage payment frequencies, doing lump sums. That's all very, very easy to do with these other lenders.
I see. And I understand that every single time you go to a bank, they pull your credit, right? So with you, do you just pull the credit once or for multiple times for each lender?
I pull their credit once and I utilize that credit bureau for all of my lenders. If I feel like I want to take it to 3 different lenders, then they'll still use that one credit bureau. And that's also a big benefit of using a mortgage broker is the fact that we do only pull it once. So we do the shopping for you to make sure you're going to get the best rate, but we only do the credit pull once, so it doesn't negatively affect your credit.
And the importance is because if you go to each bank will pull your credit, and once you pull your credit more than a few times, then it starts to bring your credit down, right?
Exactly. You turn into what the Equifax calls a credit seeker. You multiple credit pulls at a certain period of time, and it will decrease your score sometimes up to 30 points just because of credit pulls.
Why does Equifax do that?
They feel that if there's too many pulls, it might be a situation where somebody is in hardship, that they're searching for credit in order to cover some expenses. So they're applying for many credit cards or loans or what have you. In the same breath, Equifax has gotten a little smarter with some of the credit pulls because when you go and shop for a vehicle, even though you might only go to one dealership and one dealer, that dealer can end up pulling your credit 20 times in one day.
Why would they do that?
It's just the system. It's unfortunate. But Equifax has adjusted their scoring system based on the fact that if that 20 pulls happens in a matter of a day, then or even a few days, then it only counts as one credit pull versus 20.
But for bank, usually you don't do it that fast, and there's no 20 banks in Canada that we could do that for. So that's why you would take a hit if you go to each bank, right?
Exactly.
How does a mortgage broker get paid? Like, does the client have to pay you?
In 90% of cases, the lender pays us. So in the A world and in the alternative, the B world, we get paid directly from the lender. So just for bringing the business to that lender, they pay us. So there's no fee to the client. in the private world or in the commercial world is the only world that we have to actually charge a fee in order to get paid.
Okay.
And that would be disclosed to you up front.
Okay. So at no point will there be a sudden fee that comes up where we have to pay that we didn't previously know about?
Exactly.
Okay.
To the broker anyways.
That's good to know. Mortgage brokers can give us the best rate. Why do people still gravitate towards the bank?
People are predisposed to go to their bank. It's what's been ingrained in us for a long time. And in the past, I'm not even sure how many years ago, mortgage brokers were really only for those people who could not qualify in the bank world.
Okay.
So if somebody's going to see a mortgage broker and they have that old mentality, they're thinking that, well, you're only going to a mortgage broker because you can't qualify in the bank world. Now, and over the past, I'd say at least 10 years, it's been, mortgage brokers are more out there to help clients and do the shopping for the clients, and we do get the best rates. So we're getting to be more and more common as the years pass, and we're hoping to push more of the market share towards mortgage brokers because the banks have such a, they have so much of the market share that I think it needs to be spread out a little bit more. They're not giving the clients the best rates anymore.
Okay. So you mentioned before that as a mortgage broker you have access to many lenders and that they pay you. What stops you from putting someone into the lender that best suits you and you get paid the most through that lender? But it might not necessarily be the best for the client, but it's best for you. What stops you from doing that or any other mortgage broker?
We have a fiduciary duty to our clients. That's a requirement of the Real Estate Council of Alberta for our licensing to do the best thing.
So you guys are regulated.
We are regulated by the Real Estate Council of Alberta, and our duties to our clients and to our lenders are different. But with our clients, it's to make sure that we're putting them in the best situation for them.
Mm-hmm.
And I always emphasize for them because there are situations where they want to have the better prepayment privileges, but they're going to be paying a little bit of a different rate in order to get the better prepayment privileges. Or maybe they really just want the lowest rate out there, even though it's going to decrease their prepayment privileges. All these things are fully disclosed to the clients, but it's a conversation that I always have. What's important to the client?
I see.
For the most part, I don't think as mortgage brokers we look at what we're going to get paid from each individual lender. It's pretty standard. And it's pretty standard out there.
Oh, okay.
There's not big variances in regards to that. We get paid based on the amount of the loan and the length of the term that the client is going in for. So, if you really wanted to have a 1-year term and you're feeling like your mortgage broker is pushing you towards a 5-year term, really ask the question as to why. Because, it is what's best for you and what you want more than what they want.
Sounds to me like each client is a unique sense because some people want earlier payment, some people want to pay more, some people want lots of different things. So how do you determine what a client wants? What kind of questions would you ask them and what can they tell you to help you structure it so that they have the best thing in their interest?
I call myself a mortgage planner because I look at what's the client's long-term goals. I'm not here for a transaction, I'm here for a relationship. And I think that should be important if you're at the bank or if you're with a different mortgage broker, is what is your long-term goals? So when you're purchasing rental properties or when you're refinancing rental properties, it's a big question of mine as to what's your long-term goals. Are you planning on flipping this property? Are you planning on holding it for a certain period of time and just cash flowing on it? Mm-hmm. Or is this your actual retirement plan, is to have this mortgage paid off and 100% cash flow going into your pocket? Because those will determine the amortization, those will determine the term of the mortgage, the prepayment privileges. All those questions are so important. And it's the same thing when you're purchasing your owner-occupied property. We want to make sure that you're going to be, paying your property off as fast as possible. So giving you the tips and tricks to do that and pay less interest on your mortgage overall.
Okay. When looking for a mortgage broker, what are some key things that somebody should be looking for, or some questions they should ask to make sure that the mortgage broker is the right fit for them?
I think that just a basic conversation with the mortgage broker will give you an overall feeling if they're looking out for you and your best interest. I always say to follow your gut. If they're not answering your questions very well, if they're not being thorough enough, I always like to educate my clients almost to the point where it's a fault. Because I want you to understand what I'm looking at, what the lenders are looking for, and I'll tell you the things that I could see possibly come up as an issue, just so that there's no surprises. I like to let you know what the next steps are and what to do going forward. I always like to tell the story of my own first experience buying a house where I was pretty much walking in the dark. I didn't have a realtor that advised me of anything. I had no idea what to expect. My lawyer didn't tell me he had missing documents until a day before closing date.
Wow.
And I wish somebody would have
guided
me through that process so that I knew what to expect, when to get on people's cases. And I, of course, wasn't dealing with a mortgage broker at the time.
So a mortgage broker would be able to have helped you with all this process and what to do, who to look for, what kind of things that you should be asking, right?
Absolutely. And it's important to ask those questions. And when somebody starts asking me those questions, I feel that, they're really looking for the education. I'll just start talking and tell them, from the beginning right to the end, what to expect, who to call, and even give them good referrals of good realtors and lawyers and home inspectors and you name it. I always want to make sure that my clients are, number one, protected, and then secondly, that they're educated. Well, I guess they go hand in hand, educated and protected at the same time, that they are not feeling like they don't know what's going on.
How long does this whole mortgage process take? From the day I find a property and I start looking for financing, how long would it take to get approved?
Well, basically from the moment you put an offer on a property to the moment that you are approved for the mortgage, it should only take at most 5 to 7 business days. There are busier times throughout the year. There are extenuating circumstances in every situation. Most realtors like to give us the full 10 business days to get it completed, because there's situations where we need to order an appraisal. An appraisal will tend to take, a good 3 to 4 days in order to get it in our hands. So those are the things that you look at as well. So we like to start the pre-approval process before you start looking for houses and going out with a realtor. Once you have the pre-approval, and the pre-approval, I'd like to come back to that as well. But once you have the pre-approval from the mortgage broker and or the lender, then you would go ahead and start putting an offer, looking at properties, put an offer on a property, and then as soon as I have the offer in my hands, then it's looking at that 10 days in order to get financing fully complete.
Okay. Very often you get some kind of letter saying that we've been pre-approved for X amount of a house. What does that mean?
It really means nothing.
Oh.
I hate to say it that way, but in the same breath, it's especially when you're looking at a high ratio, so an insured mortgage. The insurers, the lenders, give us guidelines to go with. And so we have this box that we have to fit the client into. So we look at the client's credit, we look at their down payment, we look at their income, we look at the full application, and we say, this looks exactly what the lender's looking for. And there's a lot of circumstances where I still want to get the lender's eyes to look at it. So I'll send it off to a lender to get them to review it as well. But CMHC and Genworth and can guarantee the insurers, they are the ones who have the final decision, and they don't do pre-approvals. So if you're going to a bank, this is the same situation as going to a mortgage broker. The insurer does not review applications without having an offer on a property. So, and I advise my clients of this, even though you're going out and looking for properties, that still could come up, you could still end up having an issue getting an approval because CMHC hasn't done their review. And they give us the guidelines. They
have the final say.
They have the final say. They give us the guidelines, but there's still certain circumstances where they come back with something that you would never have expected that causes the application to be declined. So that's where a pre-approval is only as good as the eyes that have seen it. And there's nothing more that I can say to, we try and fit it in the box, but in the end it's the insurer.
It sounds like it comes down to experience a lot. Like if you dealt with CMHC a lot, then you would get to know what kind of things they would come back with.
Absolutely. And that's so important, because if you have the experience, then you've seen certain things that CMHC or Genworth have come back with as far as concerns, and you can kind of weed that issue out before you would send the client out looking for a house.
Does CMHC tell you things like when they change their rules, what kind of rules are changing, how you can fit them better in the box?
Yes. CMHC always sends out their guideline changes. We have access to their websites so that we can see what their guidelines are at any point. But they still like to come out with different things along the way, and I recently found out that they look at the overall debt load to the income, meaning what the actual balances are on the debt to what your full income is, not just the debt service ratio. It's looking at how much overall is owing.
I see.
And so those are things that have recently come out that there's no guidelines, there's nothing that tells us that they look at that. But that was a concern for one specific client. So now going forward, I look at that, going, is that potentially an issue?
How do you differ as a mortgage broker from a mortgage broker that I can find in a bank?
There are no mortgage brokers with banks. They're basically mortgage specialists.
Even if it says mortgage brokers on their card?
If they're a mortgage broker, they should be licensed through the Real Estate Council of Alberta, and they've never had to do the training in order to do that. So unless they're a one-off where they actually have had that experience, that training through the Real Estate Council of Alberta in order to have that license, then for the most part they are just bank employees that specialize in mortgages. So I like to say that they are mortgage specialists for CIBC, Bank of Montreal, because they really only deal with one bank.
So they can't offer any other lenders, just that one bank?
Exactly.
Okay.
And that's where when I'm asked, as a mortgage broker, what bank do you work for? I laugh at that because of the fact that I am a true mortgage broker. I have access to 20 different lenders. I have access to the banks as well. So when I'm looking for the best deal for my client, I'm not just looking at one set of products for one lender. I'm looking at multiple products for multiple lenders and making sure you fit in that. And versus a mortgage specialist with a bank, they only have their set of products. Okay. And they may have, background people that they refer out to that also, like, for example, Royal Bank has a alternative side of Royal Bank. That's their way of retaining their clients that don't necessarily qualify right now. They hate to send them away, but they are still Royal Bank employees.
I see. So do banks frown upon mortgage brokers?
Banks don't like us, yeah.
Why is that?
Because of the fact that we're forcing them to be more competitive and cut their rates down.
Okay. Because you can offer a discount rate, whereas they want to offer the posted rate, which would typically be higher, right?
Exactly. And so they go and they would say, if a client goes to the bank first and says, what are you going to offer me for my mortgage? They might come back with a 3.29, as I said earlier. But then they come to me and I can offer them 2.99 or 2.89. Sometimes that same client will go back to their bank and say, well, why didn't you offer this to me? Oh, well, I'll give it to you now. So they'll do the price match on it. Okay,
but only after they find out that you can offer something better, and go back to the bank and they're like, well, yeah, sure, we can do it.
Only after the client had to do the work to find that out. And that's where I wish that the banks would just give the best rate right off the bat to the clients that deserve it.
So why don't they?
They want to make more money.
And they make money by having you get the mortgage with them. And the higher interest rate you charge them, then the more money they can lend out again, right?
Exactly.
I see.
Exactly.
Can you explain what a CMHC insurance is?
CMHC Insurance and Genworth and Canada Guarantee, they are the insurers that insure your mortgage. In the case that you default, they will pay the lender for your mortgage.
So it doesn't protect the client itself.
No.
It protects the lender.
Exactly. So it's insurance for the lender on you, but you have to pay that fee in order to do it. So that's
Sounds kind of backwards.
that's the cost to put less than 20% down, is that you have to pay the
Okay.
CMHC fee.
So anytime you put in less than 20% down payment on the purchase price, you would have to pay this fee.
Yes.
Okay.
And it's tiered as well. So if you put only 5% down, you pay a premium right now of 2.75%. If you put less than or more than 5% down, at 90% loan to value, so 10% down, you pay 2% in CMHC fees. So it is tiered based on how much you put down.
So is the range, so from 5 to 10 is that amount. Right? So you could pay 7% down payment if you really wanted to.
You could pay 7% down payment, and you're still going to pay the 2% CMHC fee.
Okay. And minimum is 5% down payment?
Yes.
What about the cases where you mentioned 100% financing? Is there CMHC on that one?
Yes. So what that is basically I've structured a down payment coming from borrowed funds.
Okay.
And so there is technically that 5% down still going towards your mortgage. So then you still pay CMHC at the 95% financing
Okay.
stage.
But if you borrow more, let's say 20%, then does that waive the CMHC even with the borrowed funds?
Yes.
Okay.
If you borrow the full 20% so that you avoid CMHC,
I see.
then you would waive the fee.
Okay. And what is the mortgage insurance? Is that something that everybody should be getting?
Mortgage life insurance
Yes.
is life insurance on the mortgage as it sounds. So it's basically the situation where if you have a husband and wife, if one of them were to pass away, then the mortgage would get paid off. Now, true mortgage insurance is a depreciating balance. So as you pay down your mortgage, your coverage is also decreased to what your balance is. So that's where the mortgage insurance is seen as being negative, because you pay a premium based on that full amount at the beginning, and you continue to pay that same premium throughout. But that premium is adjusted if you're doing a term insurance versus the mortgage insurance. Usually term insurance will be more expensive because of the fact that it is not depreciating. But for some people, they just want to know that their mortgage is paid off if something were to happen to them, and that's it.
Is it something you would suggest?
No, I always recommend term insurance if you can afford it.
I see. Just because it provides a little bit more flexibility to cover other things than just the mortgage and also the depreciation part, right?
Exactly.
When my term is coming up for my mortgage and I need to renew, what happens? Sometimes I know I get a letter and then my previous lenders tell me to renew. Is that a good idea, just to sign the paper and send it off?
No, it's not a good idea. It's always a good idea to take a look at what's out there at that point. I have lots of clients that are up for renewal, and I ask them just to send me their renewal letter, because I want to review it and make sure that they're being offered the lowest rates
I see.
for what's out there right now. And there's no way the client would know what's offered right now.
Yeah,
so
they're not always in the business like you are, looking at
Exactly.
the mortgages.
So it's nice for me to just take a look at it, and if I feel that the lender is offering them the best rates, then yes, just sign it and send it back based on what, the conversation that we have. But if they're not getting offered the best rates, then I can go around and look at what the best rates are out there.
Shop for them.
Yeah.
Okay. So how big is this percentage where you just tell people to sign it off because they are being offered the best rate? Is it a low percentage, a high percentage? Or does it vary?
I'd say it's even a 1%.
Really?
It's very
That
low.
little?
Yes. Most lenders, there's this, especially with the major banks, the banks will always offer them the posted rates.
Which is high.
Yeah, extremely high. So the clients get this letter in the mail, and they're just surprised at these high interest rates, and they're calling me going, well, this is the rates. Is this true? And it's always a situation where the bank wants the client to go to the bank, sit down with the finance person before they're actually going to negotiate the rates. So they want them to actually book that appointment, get them in, sit them down, and take the time out of their day to do that. Versus send me the letter, I can take a look at it, give you what's the best rates out there right now, and get you approved for your renewal. And with a transfer, when your mortgage is up for renewal, we can basically transfer your mortgage from any lender to unless it's a collateral mortgage, which is a whole different story. But you can transfer your mortgage from that lender to a new one with no cost to you.
Oh, so there's no penalty at all to transfer?
No penalty, no appraisal fees, no legal fees, nothing.
Okay.
The new lender pays for it all because they want your business.
Okay, so when you transfer, you also renew at the same time with this,
Yes.
whatever rate it is?
Yes.
Can you tell us the different types of mortgage?
The different types of mortgages, there's different aspects to a mortgage. There's fixed and variable and open and closed. And a lot of people get these different terms confused.
Okay, so let's start with the open and close. What does that mean?
Basically, an open mortgage is you can pay it out at any time with no penalty. A closed mortgage, you will have a penalty dependent on what the lender's requirements are. Usually it is 3 months interest or an interest rate differential, whichever is greater.
Okay.
And
can you elaborate a little bit more on this interest differential?
An interest rate differential is basically the spread between the current rate that you're paying and the current rate that is being offered for that same remaining term. So if you only have 2 years remaining on your mortgage, the lender's going to look at what the rate is right now for a 2-year term and calculate the difference between what you are paying and what that rate is, and multiply that by your balance and the 2 years that is remaining. So in the past couple of years, that interest rate differential has been in effect because we are in a decreasing interest rate mortgage, which causes penalties to be very high. But in an increasing interest rate mortgage, your payout penalty will be just the 3 months interest.
So when does it make sense to do something like this?
To do the prepayment privilege?
Yeah.
Or, it only makes sense if you're going to refinance because of a situation where you need to pay out some debt to relieve some financial stress. If you're going to be selling your house and moving, some people would rather pay the penalty and get a new mortgage at that point. But in the last couple of years, with the interest rate differential being in effect, there hasn't been a whole lot of situations where the clients have felt that it's worth it just because it's been such a big penalty.
Okay. So if I'm living in one home right now and I wanted to move to a different home, can I transfer the mortgage?
In most situations, yes, you can port your mortgage. There are certain products that you're not allowed to port your mortgage over. But you would basically try and coincide within a very short period of time your purchase of a new house and the sale of your house so that you can transfer your mortgage from one property to the next.
Okay. And what is the difference between a fixed and variable mortgage?
A fixed mortgage is basically your rate is fixed for the full term that you have it. A variable rate mortgage is going to vary depending on prime rate, and that of course is dependent on the Bank of Canada.
I see.
So right now the variable rates are sitting at prime minus 0.40. So at prime being 3 minus 0.40, you're sitting at an interest rate of 2.6%.
Okay.
So that can fluctuate month to month. Sometimes we've had changes every single month where your payment is going to change as well because of the variable rate.
So your payment changes as well? It's not a fixed payment and then they adjust their principal and interest accordingly?
Some lenders keep your payment fixed and they adjust principal and interest, but most lenders will adjust your payment because if you're adjusting principal and interest, then you're changing your amortization as well.
I see.
And that changes the terms of the mortgage versus just changing your payment, then it keeps your amortization the same.
Okay. So is there an incentive to go with one or the other, variable versus fixed? Which one's better?
With rates right now for fixed rates being so low, most clients are going for the fixed because you're guaranteed 2.99, 2.89 for a full 5 years. Why not go for that? But in the past, variable rate has generally been has been cheaper than fixed rates. So that's where a lot of clients will go for the variable if they have flexibility in their budget. And that was always a big question when I talk to clients about fixed versus variable, is how structured are you on your budget? If you have wiggle room, a lot of wiggle room, and you want to try and do the variable, you can go variable and you can still lock in at any time, but you would be playing the market. You wouldn't be locking it in for the fully discounted rates.
So you would be watching it all the time?
Yes.
Okay. Some of the terminology you've been using is term, amortization, interest rate. Can you explain more about this and how it would apply to a person?
Your term is the length of your mortgage, so or of the current interest rate that you're paying. So you would get a 1-year term, meaning that you'd be guaranteed that interest rate for 1 year, and that would be your term. Versus your amortization is how long you're going to pay the loan, how long it's going to take to pay the loan. So, for the most part, it's 25 years. There have been times where it was all the way up to 40 years, but the 40-year amortization is gone. And only on a conventional basis can you actually get a 30 or a 35-year amortization now. Mm-hmm. But insured, it needs to be, or high ratio, it needs to be a 25-year amortization or less.
I see. So what kind of questions do you ask to determine how long a term should be for a client? Because it can range from a year to 5 years and possibly even different ones. How would you know which term to put someone under?
Again, that goes down to my mortgage planning. I'm there for the relationship. So what is the client's goals? What's their long-term plans? If, as a realtor, not as a realtor, but if the realtor is asking the same questions, then they're looking at a house that they're going to buy, fix it up, and try and flip it in a couple of years. Then, of course, we only want to look for a 2-year term and avoid any pale penalties if at all possible. If we're getting a lot of inquiries nowadays for a 10-year term, because the 10-year rate is very low as well, and you're guaranteed that for 10 years. Mm-hmm. The question, again, goes to the client: is there any indication that you feel that you would not be keeping or staying in that house for 10 years? Because the payout penalty for the first 5 years can be pretty nasty. After the first 5 years, it's the same as the greater of 3 months interest or an interest rate differential. But if in the first 5 years, you have a feeling that you might be selling the house, or you're expanding your family and the house only has 2 bedrooms, that kind of situation, then you might want to look at a shorter term than a 10-year. So we look at the overall, where are you in your life and where do you want to be, and what's the big picture, so that we can determine the term that is appropriate for the client.
So one key to finding a good mortgage broker is in the questions that they ask, right? So it shouldn't be up to the client to know what they want. It should be up to the mortgage broker to ask the right questions, to draw out the answers from the client to determine what mortgage to put themselves under, right?
Absolutely. You would go and ask the client and get to know them. They're just married couple that plan on having kids in the very near future, and they've just recently got into their jobs. You're going to change their terms versus somebody who is empty nested and they're just focusing on paying off their mortgage as fast as possible for their retirement plans. It all is a major factor in what the type of products you're going to put your clients into.
Very oftentimes we hear the word refinance. What does that mean?
Refinancing your mortgage is basically changing the terms of it. So you're going to be paying out your existing mortgage, and whether it is to take some equity out of your property, to do other investments, or to pay off some debt, you're refinancing your property to take money out of it, and you're changing your mortgage terms to what the current terms are. There are other ways that you can do it. If you're staying with your existing lender, you can do blend and extend or blend and increase, where you're basically blending the current rate with a new rate with new money. But that depends on the lender and if you fit the products of that blend and increase.
I see. So when does somebody want to refinance? When does it make sense to do something like that?
In a situation where they have bigger goals, they want to maybe decrease their debt service load and pay off some of their unsecured debt, or they have the bigger goal of, I want to invest my money and do something bigger with it. Then
this is very applicable to those people who have their house free and clear, meaning that they have no mortgage on it. So can people like that refinance and just put a mortgage on it, take that money and do something with it?
Yes. Up to a maximum of $200,000 they can take out of their property.
What if the house is valued at less than $200,000?
Then they would only get up to 80% of the value.
I see. And the value is determined by appraisal?
Yes.
Okay, so all lenders will have to see an appraisal to determine what the house is worth and then determine the loan on that.
Yes, there are certain circumstances where the lender might not require an appraisal, but that is a situation where they're back-end insuring it through the insurers, and the insurers are doing their own valuation of the property. But I prepare the client more than anything to have to pay for that appraisal, and then if they don't need it, then that's just beautiful.
Can you tell us what a HELOC is? The spelling is HELOC.
A HELOC is a home equity line of credit. A lot of clients really like the product because it's revolving, which means that you have the ability to draw it down, pay it back, draw it down like a credit card at any time. Only it's a really low interest rate compared to credit lines and credit cards. It's usually at prime, and right now it's actually at prime plus a half, so 3.5%. So that's a very nice product because you can pay it down and reutilize it at any point versus a mortgage where you just pay it down and you don't get to use it again. But it's also a dangerous product for those people because the required payment on it is interest only. So somebody could get stuck in just paying interest only and never actually pay down the principal. So that's where another conversation as a mortgage engineer that I would say, what's your overall plan? If it really is, I'm going to utilize the benefits of this HELOC, then yes. But if it's really, you know what, I just like the flexibility of it, the interest only, maybe not the best product for the client. You want to make sure that you emphasize that they have to pay down principal.
And a HELOC interest is usually higher than a conventional mortgage?
Yes. So you're looking at prime plus a half at 3.5% versus the interest rates right now for fixed and variable is at 2.99 for 5 years. So if you're not going to be utilizing the benefits of the HELOC, then you're better off to do a mortgage because then you're amortizing your mortgage, paying down principal, as well as getting a lower interest rate.
Another terminology used when getting a mortgage is payment frequency. Can you tell us what some are and why you would go through one versus another?
Yes. Payment frequencies, you have options of monthly, bi-weekly, weekly, semi-monthly, and then you even have the accelerated products, which is accelerated bi-weekly and accelerated weekly. So your mortgage is generally set up as a monthly payment. Now you can increase your payment frequency, and in doing that you're actually going to decrease the amount of interest you pay because you pay your mortgage more frequently. You're actually paying less interest overall, which means you decrease your amortization. So if you're taking a bi-weekly or a weekly mortgage payment, you're going to be paying down your mortgage faster. If you accelerate it, you're going to be paying it down even faster than that. And the reason being, a regular biweekly versus an accelerated biweekly is basic math of accelerated biweekly. You take the monthly payment, you divide it by 2, but you pay 26 payments. So you're in essence paying a full mortgage payment more every single year. That's how it's accelerated.
Okay, just the extra 1 month makes all that much of a difference.
Exactly, and a regular biweekly, you're taking the monthly payment, multiplying it into the year, so multiplying it by 12, and then just dividing it by 26 payments. So you're really just taking your full year's worth of monthly payments and setting it up into be biweekly. But you're still attacking your principal because you're paying it faster, so less interest accumulates.
As part of this home buying process, what are some other key members that a person might want other than a mortgage broker?
You want to have a very good realtor, and I emphasize that because I've seen a lot of realtors that haven't necessarily made sure the client was protected, didn't educate them on certain things that they necessarily should have. Not that I'm in that profession to know what should be educated, but there was the situation where the client came to me asking me these questions, and I don't know the answer to them, but I needed to educate them somehow, so we had to find the answer. So a good realtor is so important. And then you also want to have a good lawyer. The lawyer is going to go through the mortgage documents, make sure that the real property report and the contract, the purchase contract is all very thorough. Make sure you're protected as well. And you're also going to want to have an insurance agent. You want to have insurance on the property, as well as if something were to happen to you after you buy that property, that your family is protected and everything's covered. So those are important key members.
And once you have this mortgage broker, then that basically means you don't need the mortgage insurance at all, right?
Exactly. If they can give you a better product, that you can, and the biggest part is the affordability. Sometimes when people get into a mortgage, they don't feel like they can throw another payment into theirs for the term insurance. That is the ideal route to go, or a whole life, something other than the mortgage insurance in essence.
So that would just give you more flexibility to cover the house as well as many other things that might need to be covered.
Yes.
Right? Sometimes a lender would decline a person and you would have to go search for a B lender. Do they give you a reason why, and would you pass that information on to the client so that they can rebuild whatever they need to get to the A lender world?
Yes. We want to make sure that the client is always aware of what's going on, the reason that they're declined. A lot of times clients never see their credit bureau until they come and see me, and then I can go over the credit bureau with them and show them what's on there and what things mean, and that's so important to know what's on your credit bureau. And if I've found that many circumstances a client has come from the bank and they didn't know why they were declined, or perhaps all they were told is there was something on their credit, but they never got any emphasis, they didn't explain it very well as to what happened. I think this is so important for the client to know, so that they know what to go ahead and how to structure things, how to fix what's on their credit bureau, or if it's an income situation, how to plan going forward to make sure that they can qualify in the future. But if it's a situation where it's going to be many years before a client can actually get approved, then we might take them to an alternative lender. Just because the alternative lender, they're a good option. I mean, the rates aren't that high that you would be deterred to going for them. You would not want to go there, but they're still very good lenders.
So is a bank even allowed to show the client their credit?
It depends, the different policies of the different banks. I'm allowed to show the credit, I'm not allowed to give them their credit bureau. That's the difference.
So you could show it on your computer, and then you could teach them what everything means, but you can't actually physically give it to them or email it to them.
Yes.
But they can always get it on their own for free from Equifax, right?
Yes. And that's always the best way, is to get the client to contact Equifax or go on to equifax.ca and pull their own credit bureau. It's so important to have your own credit bureau and monitoring it. It's so easy for a creditor to put something on there, but it's very hard for you to get it off. So.
And there are ways to protect yourself if you feel that you're a victim of identity theft, right? You could put a note on it so that if there is anybody tracking the credit, then a lender could call them and confirm it is them, right?
Yes.
For those people who are real estate investors, they tend to want to gather a lot of properties for rental reasons and for passive incomes. Do we get to a stage where we can't qualify for any more loans?
No, and that's actually an interesting comment, because a lot of clients will go to the bank and the bank will say that they can max have 4 properties. Well, that's because they're dealing with one lender. And the bank,
okay.
The one bank. And that's where coming to a mortgage broker when you want to get into real estate investing is so important at the very beginning. Having the conversation, talking about your goals, talking about your long-term plans and the short-term plans, so that we know how to structure things going forward. We have so many different lenders available to us with so many different policies that we would structure those first couple properties with the lenders who will only allow up to 4 or 5 properties. Then we're going to leave the other lenders that allow you to have more properties for later on. And if you want to pull that relationship with your bank at any point, it might be to jump over that 4 to 5 properties, where I might say, okay, now is the time you might want to go to your bank and see if you can get this mortgage with them.
Okay.
The banks will only allow you to use half, so 50% of the rental income from each property.
Oh, really?
So you can imagine how fast you would max out on your debt service ratio if you're only allowed to use half of the rental income. You wouldn't buy properties if you only got half of the rental income from them. So we have so many different lenders that offer much better debt servicing guidelines than just use 50%.
Mm-hmm.
So that's again where using the bank might hinder what you can acquire for rental properties.
Okay. So even if you're at 10 properties, 20 properties, you will still have lenders that would be willing to lend.
Yes, I have a few lenders that allow you to have as many properties as you want.
So even up to 100, that's not a problem?
As soon as you get to that point, you're probably going to be commercial anyways. But yes, we have different lenders who will allow us to go to those high numbers.
Okay. To make this process go a lot smoother, what kind of paperwork would someone need to provide you to make it go faster, smoother, and so you don't have to keep contacting us to get information?
Well, basically the first thing I always get from the client is the application. The application is going to provide me with the consent in order to pull the credit.
Okay. And that's something you provide to the client?
Yes, I will provide the application. After I have the application and I've pulled the credit, I'm going to ask them for a list of paperwork. Now, that could be dependent on the client's application. So if we're going to need a letter of employment versus the tax returns, because they're self-employed, it all varies depending on what's on the application. Mm-hmm. As well as if I'm using a different payment for a line of credit, then I might want proof of that payment than what's on the credit bureau. So documentation can vary a lot, but for the most part, if you're basic employee, you're looking at a current pay stub, letter of employment, any mortgage statements that you on any mortgages that you have. If you have rental properties, any lease agreements that you have as well. Mm-hmm. And then your down payment verification, if it's savings 3 months, bank statements, RSP statement if it's RSP.
Okay, so does Keystone Mortgage provide us with a list, basically a checklist of all these documents that's required based on your interview with them?
Yes, I have a list that's on my website at www.mortgageengineer.ca. You can go download it at any time. I also have some credit blogs on there as well. And I also have my mortgage application if you wanted to download and send me the mortgage application in an email.
Okay, so what's the first step that a client would do when they call you?
For the most part, I'll do a preliminary question period with them, what they're looking for, what the overall plan is. And then if I feel that there's something that I can do, then I'll get them to download the application. If a client is just looking at wanting to purchase a property, then they can just go and download the application and send it to me because that's going to be the first step I'm going to need anyways.
I see. So can you tell us why someone would want to go to Keystone Mortgage rather than other mortgage brokers? What sets you apart from everybody else?
At Keystone Mortgage, again, it's a big part of what we do is educating. We like to make sure the clients are aware of everything that's going on, make sure that they're very comfortable with the entire process. Mm-hmm. I've trained all of my agents to do the same things that I do and making sure that everybody is aware of any negative things that might affect their application or the process. Full education. However, there are many other very good mortgage brokers out there, and it's just making sure that you're the right fit for that mortgage broker.
Mm-hmm. So how many people is part of your team right now?
I have 5 agents underneath me right now.
Okay.
We're looking to grow.
That's great. So basically, if I were to get a mortgage with you, you were on vacation, somebody else can take over and answer any questions I have. Thank you, Raeann, for taking the time to teach us all about mortgages. We really appreciate it. And if you wanted to reach Raeann, you can reach her at www.mortgageengineer.ca or email her at Raeann, RAEANN, @mortgageengineer.ca, or even give her a call at 780-914-2620. Thank you so much, Raeann Lefebvre from Keystone Mortgage.
Thank you.